So we need to change. We need to change that so that we, in a controlled manner, can get these people own a home or stay in their home if you're 50, 60, because a lot of people are being forced to sell their house because they can't afford to refinance their mortgage, or there's no product to refinance them. So we really need a change.
For the past century, UK consumers have experienced very little innovation in the mortgage space, with lending processes remaining largely inflexible and quite manual and slow. Our guest today is on a mission to change that and revolutionise the UK mortgage market with an innovative digital mortgage bank. Perenna Bank have launched a groundbreaking 30-year fixed-rate mortgage requiring a minimal deposit. Their advanced tech platform stands out in the mortgage market, offering rapid approvals and enabling users to track every step of the application process on their mobile devices. We spoke with Arjan Verbeek, the co-founder of Perenna Bank, who has spent over 20 years in the banking sector working for major institutions like Barclays, BNP Paribas. We also explore Arjan's journey in convincing investors of their unique funding model and how that works. We also talked about the UK market and how it's evolved in a different direction compared to the US and other European countries, which I thought was really interesting. We also dive into the mechanics of long-term fixed-rate mortgages and how that works. Really great conversation. Arjan's a brilliant speaker. I really think this bank are going to do great things. I think they're going to be really disruptive in this marketplace. Yeah, so I really look forward to what they're going to do. It's Arjan Verbeek. Thank you so much for coming on the Tech Leaders podcast. I've been really excited to talk to you. I think your company, Perenna, are doing some incredible things and really disrupting the mortgage market especially. So I can't wait to talk about that. But first of all, Arjan, what does good leadership mean to you?
To me, I think it is getting people to follow you on a journey. Right. And that is important. You set the right example, you show the right values, and particularly you explain why. Because to get people with you on a journey, you have to believe in it yourself, but also make others believe and that you're doing the right thing. That's to me good leadership. So people need to willingly follow you in that.
Absolutely. Very well said. Very succinctly said and very well said. So how do you go about getting people to follow you, Arjan? How do you create a positive culture in your business?
Well, it's not easy because everybody is different and everybody has a different way of looking at things. So I try to really explain why I do something, that I don't say, this is it, we do this. I try to give the reasons for it so that people can see that it's not just me thinking this is what it is. I don't have any hidden agendas. Yeah. I open up to people. I make sure that everybody has got a benefit of gaining themselves and growing themselves and reach their own ambitions and targets with that. So there's alignment across everybody. That's, I think, the key thing to make that happen. It's not easy, but people are all different. You need to get the right minds together, really.
Absolutely. And you need to have a business plan that you believe in, which you clearly do. So some of the listeners will be unfamiliar with yourself and with your company. But for zooming in on yourself, Arjan, could you tell us a little bit about yourself and maybe just give us an overview? You grew up in the Netherlands. Obviously, you got into the banking sector in the mid-90s. Can you give us a little overview of your career right up to the point of setting up Perenna?
Yes, I went to university in the Netherlands. I actually did econometrics, and that probably was
I know it well, yeah.
Well, it's a study that I think only got put in place when the computer started because it made it possible really to statistically model economic parameters. And then straight after my study, I was really interested in the financial industry. So I got a short traineeship into London, which was obviously the financial heart of Europe at the time. Joined a corporate banking traineeship at the Royal Bank of Canada. Then joined Moody's at the beginning of the securitization in Europe. And after a couple of years there, a new instrument was introduced into the UK. So we had securitization, and then it was a structured covered bond was introduced by one of the big banks. I rated that for Moody's and then joined BNP Paribas to set up a team to do the same thing. And then the run up to the crisis, 2007, I was at BNP, and then unfortunately things went wrong. you start looking back and seeing what went wrong, why things went wrong, analyzed what went wrong, and
so you're referring to the financial crisis around 2008.
Exactly.
Of course. You were working in BNP at the BNP Paribas, one of the biggest French banks at the time. What was that period like?
It was interesting because it was actually a BNP Paribas fund in August 2007 that was the first one that closed. And it says, sorry, we cannot give people their money back because we can't sell any assets. So for me, the start of the financial crisis was really August 2007, when most people think that the crisis really started in 2008. But that's when the writing was on the wall. BNP was a good institution. They have a good strategy. They have a very clear strategy. You might not all like the strategy, but it's a very good one. And in the big bank, you could see the local support that BNP had. Everybody in the crisis started looking at their own country, was retrenching basically going on. And banks stopped lending, as you might still remember. That was a very challenging time, but learned a lot of the mistakes made.
What did you personally learn from that period, coming out of that period, Arjan, which was a good lesson and useful for you when you were growing your own business?
Yeah, so my own business and the start of Perenna comes from the learnings that we did and that we made in the crisis. Because what we did in the financial crisis is increase leverage. We increased leverage a lot. And the products, particularly in the mortgage market, the 2-5-year short-term products, they increasingly became more aggressive. People could borrow more. People could self-certify their income, and leverage got out of control and uncontrolled by regulation. Unfortunately, only after the event, the regulations became tougher, so that risk was controlled. But the regulations then also locked up the entire market, which meant that people couldn't own a home anymore. And home ownership has been declining since the financial crisis quite significantly, which is not good either, because if you don't own your home and you go, for example, if you don't own your home in retirement, you need to have a much bigger pension pot to be able to pay for rent. And that creates a lot of instability. So we could see that happening. And with technology becoming a bigger and bigger player, money is getting faster, as we say. You know, it took forever to take, even Northern Rock people were queuing out at the branches to take money out, of course. But nowadays, it takes you 20 minutes to empty your 10 bank accounts on your phone, right? So money is much quicker taken out of the banks, and that has a real knock-on effect and the risk for banks if you fund a mortgage with a deposit. So that is really an eye-opener. You could see this all coming, which is why we started Perenna, because what we're doing is, and they've done this in Denmark for a long time, but also other countries, if you have a mortgage with a long-term asset, if you like, you want to fund that with long-term money that you get from pension funds and insurance companies. You don't really want to fund that with deposits, because that creates a risk in the financial system, particularly because of technology that has made everything so much faster and cheaper and easier to manage.
Yeah. No, absolutely. Can I just set you a bit of a challenge here, Arjan, while we're here, and we'll get back on track shortly. But I wanted you've obviously given a bit of a description of what went wrong during the financial crisis. There'll be some people listening to this episode who are not so familiar with that period. Can you basically just, in a nutshell, try to explain what happened, why there was a financial crisis, and how that changed the financial services sector, especially in the City of London?
So what happened was that it was obviously a good economic, in the beginning, at least a very good economic period. Inflation was controlled, interest rates were fine at around 5%. People were getting wealthier, active. It was after the crisis of the late 80s, early 90s. Everything was in recovery, and the economy was working well. That meant that people felt good. They wanted nice houses. It was a very competitive market, and people borrowed increasingly to buy assets, and particularly houses.
Yeah.
Now it's all about affordability. If you have £1,000 to spend every month, you have to make sure that you can meet your mortgage payments. So the bank started offering products that met that £1,000 threshold, but they kind of forgot that if anything happens, your £1,000 might be different. And also, the banks started lending to people that said they could afford £1,000, but could they really? Is a bit the question. There wasn't a real check on that. So people just wanted to buy the house, and they then borrowed the money. Now, what happened at some point, and particularly also in the US, a lot of people borrowed, and bought houses that pushed up house prices to an enormous number of multiples of income. And at some point, people started thinking, well, everybody on low incomes is owning, a house, and can they really afford it? When the doubt started coming into the system, the money dried up, the lending stopped, and when people couldn't roll over their mortgages, they started defaulting, and particularly in the US, the pressure built, and that completely stopped everywhere at some point. At which point, the banks couldn't fund themselves anymore because the market didn't know what the risk was in the banks, and that's when the governments had to step in and rescue the banks because of the risky lending that they've been doing. The banks got a guarantee system from the government so that they at least could access the markets and fund themselves. It was a scary market. Some banks went under, as we know. Most of them were rescued. The other thing that happened at that time was the central banks. They stepped in and supported, and they lowered interest rates to a very, very low level, almost unacceptably low level. If you're an economist, and I am, money should never be free, really. And it basically was. But that obviously helped everybody, because if you have a lot of debt, but it doesn't cost much, you will not default. So that really helped the market to recover, but it became artificial. And it stayed probably too low for too long, because money was cheap forever until, was it 2 years ago, when interest rates started going up again. And that's why we now have the challenges that we currently face, where people suddenly have all the shocks because people had a 2-year fixed or a 5-year fixed. They're now increasingly moving to a payment which is 2 or 3 times as much, and that creates a new risk in the system. So it all started with building up this leverage in the system that we then kind of could afford, because interest rates were put on a very low level. But that at some point had to go up because inflation must go up. You had geopolitical issues. And now we're dealing with risks that are not from 10 years ago. They are from almost 20 years ago, basically, when it all started.
Very, very good description, Arjan. I couldn't resist. That was fantastic. Thank you so much. Let's get back on track. Summer of 2013, you decide to leave BNP Paribas.
Yeah.
Okay, you decide to set up your own business. Talk us through that period in your life and what prompted you to make that decision. And how and tell us a little bit about that capital management organization that you set up, which then ultimately became a challenger bank.
So what happened was that I was sitting between 2010 and 2013 at BNP Paribas, servicing the clients, but you become a solution provider, unwinding structures that were put in place before the financial crisis. And then you have a certain mandate to execute, because everybody in a big bank has got their own mandate. You're all siloed.
Of course.
And then we said, well, it's great to do this, but the real solution is to do this: the long-dated fixed-rate mortgages. That's what that can turn things around in the UK. That will solve the problem over time, because interest rates are now very low. You just lock that low rate in for people, and then they can recover over time. But it was not my mandate to do that in BNP Paribas, so couldn't really do it there. Try to have other banks interested in that, not having to give up my job, because that wasn't the idea at the time. But everybody says, great idea, really see where you're coming from, but once you make it work, let me know. Right? Everybody wants to be second, nobody wants to be first. So at some point, myself and two colleagues basically said, well, nobody wants to work with us to do this. Someone has to be first. It is the right thing. Let's just do it. So in 2013, we decided to leave structured employment, as we call it, and became self-employed and entrepreneurs, setting up initially a fund manager, this Perenna Capital Management at the time, because in the Netherlands, big pension funds put funds into mortgage funds, and those funds will then buy the long-dated fixed-rate mortgages, because it's a very good matching asset. I mean, if you think about it, a mortgage goes from 30 years to zero and someone pays it down with £500 a month. A pension is from over 30 years to zero, because that's the lifespan, receiving £500 a month. So it's a great matching asset. And you see that pension funds in other countries have got a lot of exposure to mortgages or mortgage debt.
Of course.
But not in the UK. So we set up a fund manager, got that going, talked to all the pension funds and insurance companies, and then you find out that we've made some other mistakes in the past. That means that we cannot really do what's, for example, being done in the Netherlands. The pension funds were, there are thousands of them and they're small, outsourcing all their investment decisions basically to consultants, and it's a fragmented industry. And they all saw the logic, they all liked it. And then you come back to again, okay, set it up, and then once you have a seed fund, we can look at it. But who's going to seed you? There's nobody around to seed you. So it's the chicken and egg. Insurance companies, they liked it, but they had the Solvency II regulations, as they were at the time, to deal with. They couldn't take any flexibility. And to do 30-year fixed rate mortgages, you need to give the borrowers the flexibility to change their life and not be locked into their mortgage. And the insurance companies couldn't give them that flexibility. So in a fund, we couldn't actually do anything to bridge that gap between the consumers and the insurance companies. So then in 2017, we said, look, the only way to do it is to follow the Danish model, where we issue bonds that everybody will buy all day long without having to think about it, because they're very highly regulated, low risk, etc., and use that to fund the mortgages. And then we will manage on the bank's balance sheet the basis risk, so to speak, the difference on flexibility. So we put a proposal to the PRA, and in July 2017, to set up this Danish-style bank in the UK. And it would be a new funding platform, a new type of bank, because it doesn't obviously exist in the UK. This is a bank that doesn't really want to take deposits to fund their mortgages. And also then the second thing is we obviously wanted to not use the legacy technology that we have, but really upgrade that. And for the first time have one platform that connects assets and the liabilities of a bank, so that we have a very good overview of the risks that we were running in the bank. So that took a while. First, we had to educate the regulators to what this bank is and how it behaves and what that really looked like. Then we had COVID, which obviously didn't help either. So the end of last year, we finally managed to start lending, and that's going very well. There is a lot of interest. It is difficult to educate the entire market of why it is a good thing, and that it actually, people are not locked in. People are almost thinking in a certain way because they've always thought in a certain way. It's hard to change people's mindset, but we're getting there, and we can see the politicians beginning to use long-dated fixed-rate mortgages more. It has been tried before already in 2004. David Miles wrote a big report, and Gordon Brown, I think, was the one who commissioned that. People know, the government knows, Bank of England knows, institutions know that it's a good thing for the market. But then for the market to stop thinking cheap and short term is a big step, because it's difficult to change people's behavior on that side. So now, after the financial crisis, the product actually addresses issues that we have. So it just makes the market work properly again.
This episode was brought to you by Be Digital. Be Digital support leadership teams to optimize cost and get more out of technology investments. Be Digital and the team have unrivaled expertise with technology license management and data remediation, and are therefore perfectly positioned to help prepare organizations for AI technology capability. And on the last point, Be Digital have just developed a cutting-edge AI readiness assessment, which provides tech leaders with a platform they need to make well-informed decisions about AI adoption strategy in 2024 and beyond. Go to bedigitaluk.com to find out more and get in touch. So I will come back to unpicking sort of long-dated fixed-rate mortgages a little bit in due course. But what I wanted to ask you about, Arjan, you've alluded to this a couple of times, that the UK model is different, the UK industry is different to especially the Danish model. But the Danish model is quite similar to there's lots of countries who do it, that link pensions and mortgages together and have long-dated fixed-rate mortgages. Why is the UK evolved in a different direction? What's the reason for that? Why is it an outlier?
Yeah, it's a good question. And it probably started before I was active in the market, so there's a little bit of guesswork in it. But I think...
It's not your fault.
No, it's not my fault. I think it's funny how certain choices in a country just make certain things go into a certain direction. And it's not just the UK, it's the entire Commonwealth. So you can see that the market has grown in the Commonwealth countries in the same direction.
What about America? America is more similar to Denmark, yeah?
Correct. And the American system was set up after the savings and loan crisis, and a big crisis in the 30s, where the banks stopped lending on mortgages, in the same as in the financial crisis. So what the government did, they set up an agency just to let the banks lend, and they would buy the mortgages from these banks so that they could just lend without having capital or liquidity issues. So that is similar, almost got there by solving that crisis in this way, where in Denmark it was 1850, I think. I don't know the exact date, but it's when I think the British Navy actually was bombing Copenhagen, apparently, and they needed afterwards a way to rebuild Copenhagen, and they dreamt up this system. And that's been working for like 200 years. So there's a different trigger point for different countries. We never had a trigger point like that in the UK. So the banks just grew, and the building societies were obviously doing the first lending of mortgages on deposits. And we've never changed that model. We've never had to change the model. And the deposit-taking institutions just kept lending, doing the mortgage lending. Building societies became banks when they converted, and they just grew bigger. They merged. And now we have a situation where you have 5, 6 deposit-taking institutions that basically are the biggest and control the market. The rest is following that. So there has never been a trigger to really change and rethink in a shock effect or in a real crisis how to stimulate the mortgage market.
Right. Okay. No, that's good. Thank you for that context. So I suppose this is part of your core message then, is that you are trying to change or trying to, provide a different way of doing things in the UK market. Yeah.
Absolutely, because we've had a shock effect now, which was the financial crisis, but we haven't changed. So we're still doing the same thing as we did in the financial crisis. And we've spoken to Americans, and American people they think 30-year fixed, that's the mortgage, and I don't take any risk. We have had a shock effect in the financial crisis, but we're just still doing the same product that caused the financial crisis, but we haven't adjusted to the new world. So that's why some segment of the market are just not able to borrow, because the central bank sees the risks, accepts the risk, has put mitigants in place like the loan-to-income cap. But unfortunately, that medicine is now also killing the hopes of many people to actually be able to get on the housing market. So it's creating systemic risks in itself. So we need a change. We need to change that so that we, in a controlled manner, can get these people own a home or stay in their home if you're 50, 60, because a lot of people are being forced to sell their house because they can't afford to refinance their mortgage, or there's no product to refinance them. So we really need a change.
Yeah, of course. Absolutely. So Perenna, your launch product was a 30-year fixed term mortgage. Yeah. What sort of deposit would be required for access to that product?
Yeah. So the deposit is always an interesting question. I'm a Dutchman, and in the Netherlands, we have 100% loan to value mortgages. As in no deposit down, I think they call it in the US. I'm very comfortable with that because you have to live somewhere, and home ownership is important. If your mortgage is, £500 day one and it's £500 year 30, the risk of you defaulting is actually very low. So the value of the asset shouldn't mean much, apart from the fact that if something happens, the bank has a bigger loss, so you need to charge more. But that's fine. You're still helping people onto the housing ladder. So we want to go as high as possible on the loan-to-value side. We're doing 95% at the moment. So 95% LTV, 30 or even 40-year mortgage to keep the monthly payment as low as possible and help people really onto the housing ladder. So that was the first mortgage that we put out. We also have interest-only mortgages at a fixed rate for a long term. That's really aimed at people over 50 that need to refinance onto a product that meets the regulations and matures after people's lifetime, really, so that it can be repaid from the sale of the house. So those are the two products that we're really live.
It seems you've got to focus on first-time buyers. That seems to be your core market right now. Is that fair to say?
First-time buyers and later life, as in 50 plus.
Okay.
That's the core focus now, but we are working also with partners. We're looking to work with partners. We don't want to do everything ourselves. It's very hard to go to and get the consumer touch points. There are a lot of people that fight over consumer touch points.
So you're talking about retail partners like building societies and things like that?
Correct. So we're very happy to work with building societies. We're very happy to work with brokers, very happy to work with non-financial institutions, house builders, property websites. They all have touch points, and they're all there to sell houses, right? To give people home ownership. So we are happily putting the products through them into the market so that we can focus on what we're good at, which is basically financing the mortgages instead of doing all the origin. Because marketing costs a lot of money, and if you have an easy way to do that, more efficient way, then everybody should just do what they're good at, really.
Yeah, absolutely. So you got your banking license, and obviously you've got a very attractive product with a clear purpose to provide a unique service in the UK mortgage market. It's great to have your product side sorted, but you still need capital to keep going, to get through this banking license process, and obviously scale to a point where you can stay in the game and you can achieve organic growth. So can you talk us through your investment journey from initial concept and the embryonic stages with you and your co-founders right through to today? How many investment rounds have you gone through, and how have you found trying to raise capital for the business?
Yeah. So we started by eating up our own savings. That's where every entrepreneur needs to start.
Sure.
And
yeah, of course.
And then in 2018, we did a friends and family bigger round that got us going. After that, I think just before COVID or in COVID, we did a city round. So bankers, etc., some wealthier individuals put the money in to get us to the banking license stage. To get the banking license, we needed some proper capital. We're talking about 50 million, and after that another 30, 40 million, and that came from the US. It came from a US financial services investor that put that money in. Unfortunately, the UK investor base is quite tiny. You can read a lot that the UK doesn't really invest in startups and helps us. And that's, like I said before, that's really the case, unfortunately. It should be the UK that really helps us. Now that we have our license, we need to obviously raise more money to actually support lending. So we have a deadline from an investment bank, retail bank from the continent to finance our mortgages, but we need, under every loan we write, we need to have about, call it 5% of equity. So it's 20 times as much we can lend based on every pound of equity. We need more equity so we can actually lend more mortgages out in the future. The market is very big in the UK. I mean, the mortgage market is 20 billion a month, right? It's a lot. So we just need now have the equity to be able to write mortgages to get us to break even.
Do you think this will sort of trigger a significant change, a sustainable change in the UK mortgage market with these sort of long-term fixed rate mortgages? Do you think this could be the stimulus for a more Danish model in the future?
Yeah, the Danish model is very sophisticated and has grown into something that everybody knows about. It'll take time, but I do think that long-term fixed rate mortgages are important to service certain segments in the market. People that have always gone and taken the cheapest 2-year, 5-year, and they can afford that, and they don't have any leverage issues, etc., or age limits, that's fine. They will do that. But people that fall outside that, and that's a big part of the market, they will embrace long-term fixed rate mortgages. And there's a lot of demand from insurance companies and pension funds for this type of risk. So that funding will be coming into the market. And that's just good for the UK. I mean, you want your local assets to be funded by local liabilities. That's just, it removes shock risk in the system, which is good.
So how have you found generally scaling the business and retaining the culture that you and your co-founders instilled in the organization in the early days when you were a true startup?
Yeah.
Obviously, you're now probably in scale-up territory. How have you managed to hire the best talent to come and work for you and keep your business growing from a cultural and human capital standpoint?
Yeah. It's challenging because you, particularly as a bank, I think it's easier in an unregulated business because you have a different collective skill set requirements because you're regulated. We need risk people, we need compliance people, and they are by nature different than the frontline originators and entrepreneurs that you have in a business. You have servicing people that are different. So you have a different set of cultures that you need to build the bank and set it up.
Yeah.
Which is difficult. And it's very hard to to create one culture. We haven't completely decided yet how we're going to or determined how we can create one culture. I think you'll find that every bank has got a slightly different and still the same culture. But most of the big banks have become these things that don't change, right? Because they've gone to this side. You can never get anything done in big organizations. You hear that a lot. And that's because the organization kind of weighs itself down almost because of rules and regulations. And that's what we want to avoid. So we'd like to be highly tech enabled and not become a big organization that doesn't get anything done. We want to keep the ability to do things fast and quickly. That's going to be a challenge. It's so far so good. But with growth, that challenge will remain, I think. But we're definitely looking to not change to a big mammoth.
Well, to change into something you're trying to get away from, I suppose. Is
exactly. It's hard to raise.
Yeah, it's a difficult thing, isn't it, to retain your your disruptor mentality whilst becoming more and more like the big boys, and you've got to retain that autonomy, I suppose. But can we slant the conversation towards, you talk about being highly tech enabled. Can you tell us a little bit about the technology platform you're building and what of the challenges you've encountered from an engineering standpoint on the technology side of things?
Well, as I mentioned, we need to tap into a lot of other third-party systems, right? I mean, property and conveyancing, you need to all go out and get information. If the other side is not tech-enabled, you can do very little. Mortgage systems are very low-tech still. They're very, very old, being upgraded, but they're still very old. So it's challenging. So you want to make sure, but there is investment being made, so it's growing all the time. So one of the things that we've decided very early on is to try and let systems not talk to each other. So first of all, you want one database and not every system come with its own database, because then data migration becomes a complete nightmare. So you create one database with a middle layer where all the systems plug in, your origination system, your finance system, your servicing system. And if in the future there are better systems because they're constantly being worked on, you can easily change from one to another. And that is the key thing. So a very modular approach is important. Microservices is very, very important. We decided to take the best in class and use that through our middle layer. And if they all stay best in class, great. If they become cash cows and too cumbersome, then we just take the best in class and replace it. And it should be very easy to do that. So we keep everybody on their toes that nothing can become legacy. Now, in mortgage land, that's not always easy because, like I said, property systems itself, Her Majesty's Land Registry is very slow and not really automated, digitized. So, it's going to take a while to make it as efficient as we like to be. But you see a lot of development at the customer-facing end from a lot of good initiatives where the journey for customers is getting shorter and the underwriting is getting quicker. That's where a lot of the development is at the moment.
Yeah, I remember hearing that the global banking system, I can't remember who said it now, in some sort of conference talk, I think it might have been Chamath or maybe Elon Musk or something, that the global banking system is held up with mainframes and COBOL. There's so much legacy tech there that nobody wants to touch in case they mess it up.
Well, that's absolutely true. And frankly, COBOL, that language, kind of the people that knew that are all dying out because everybody's taking up Python. And how do you change the system, right? Unless people are being taught COBOL again just to tidy things up in the system. So there is a good big bang almost necessary to replace it, but replacing systems comes with a lot of personal risk, as we've seen with a few CEOs that really have struggled with that, and one lost a job over it, which is a career risk you don't want to take. So you have to do it very, very controlled.
And a lot of these executives, these CIOs, their tenure is like 2 to 3 years, so they don't want anything to go wrong on their watch, and they have a very short-term sort of strategy normally, don't they? So, and that's probably not contributing to innovation. But I think just a very quick question on that then. So what sort of technology trends are you looking at right now, which you think are going to have an impact on the future of banking? And there's a lot of talk about AI, for example, at the moment, and blockchain and things like that. But is there anything in particular you're excited about at the moment, Arjan, in terms of technology innovation in your sector?
Well, everybody talks about ledger technology, obviously, and it should make it very easy to get records like matching up very quickly, and that is something we're definitely looking at and using, particularly also on the capital markets, our funding side, to match it with the bond side. So we keep an eye out on all of that. It's one of these, and a lot of initiatives out there on the capital market side that we want to plug into. But AI has to be the one that makes it like really become easy, right? We have tons and tons and tons of rules, regulation, documents, right? And if you can get an AI to plow through that very quickly and get answers on questions, etc., and monitor things, that is just such an efficiency gatherer. Reporting requirements are absolutely massive. If we can get that all automated through an AI, that's brilliant, right? So AI is the efficiency driver going forward, and we're very much focused on using that as much as we can in all aspects, on the origination, the monitoring and control, and on also the issuance side. It's very important.
Is that something you're emphasizing with your team right now then, looking at, are you currently using AI and automation in any critical functions of the bank right now?
Not yet in critical functions, because you need to go through a proper testing, etc. We're using it for the simple things, like write a bit of code for this, to do this. We create presentations with it. We do certain things. We're beginning to incorporate into a system, but not yet in the critical systems. That needs proper testing, etc. So, but we're definitely focused on building the bank out through AI instead of hiring people. Right? It comes back to keeping it smaller means that we can create and keep the right culture, and we use technology and automation really as much as possible to create the efficiency and best customer outcomes and experience.
Looking at the bigger picture in relation to AI, it doesn't necessarily have to be in the banking sector, but just sort of generally, I know there's talk about jobs being, we've alluded to it just now, but the jobs are going to be lost as a result of automation and in AI. I think there's no point of trying to deny that. We all know that's coming. But is there any societal or macro concerns or fears you have, Arjan, looking at the ridiculous growth of artificial intelligence innovation over the last couple of years?
Yeah. Well, it is scary, right? I mean, it is scary that you suddenly theoretically can see yourself saying something you've never said before. I mean, that is scary. That is scary.
Absolutely,
right?
Yeah.
And that is something.
You mean like deep fakes and things like that, then? Yeah.
Yeah.
And that is.
And for us, security, cybersecurity, etc., it's amazing how much spam and phishing and who knows what we are getting on a daily basis. Our controls need to be really, really tight, and particularly as a bank, you get a lot of attention, and AI will only make that worse because it becomes easier, and the scams will become more sophisticated. Hopefully we can use AI as well to protect ourselves against it. But it's really a bit of a scary thing, and that's also a generational thing. I think I can't see my parents ever get used to that, when my kids probably will grow up knowing all about that and be part of that. So it's going to be a difficult development and difficult adaptation, I think, by society to that, because it's going to go fast, right? It's almost like suddenly, bang, here it is. The development of pace this all goes. I can fully understand that the regulators are on top of it, just trying to quickly control it, because it is scary how fast this goes.
Oh, absolutely. It really is. It's and I'm sure, many things will change over. I think the pace of change is accelerating, isn't it? And it'll just be really interesting to see how this certainly impacts money and financial services and the banking system and all these type of things. So look, we mentioned there about security with, an increased reliance on digital platforms and cloud services. How is your company ensuring security and privacy for your customers, your customer data?
Well, I can't claim to be the expert on it, because it really is a specialist area. We have a cyber team. We've got that all controlled. We've got firewalls. We protect against the internet going down almost as much as we can, because a lot of it now is you're relying on cloud providers that themselves actually can go down. And if you look at the core basis of the internet itself, it's not that secure, right? It's our CTO gave a presentation once of what really happens and how it works. You think, Jesus, that's not, that's quite vulnerable. So we have a lot of security in place. We use a lot of outsourced third parties that are specialists in certain areas, because you can't be a specialist in everything. So our security blanket is quite strong. I'm glad that we're not a payment provider. So if you look at a mortgage bank, the amount of data you have and the number of transactions is very, very limited.
Yeah, sure.
Which I'm very happy about. If you go into
Yeah.
payments, you have much bigger job to do than we do. So they have a lot more on their plate than we do. But we already have a lot of third parties that are like hired police, if you like, on every vulnerable point of the bank or entrance into the bank estate. We have almost a policeman sitting there to stop and people coming in. It's very specialist as well. I really can't claim to any value add on that side compared to them. But
of course,
you have incidents quite quickly.
Yeah, but just like anything else, it is evolving quickly, isn't it? And I think you just, as long as you've got a provision in place, a team of people who are keeping on top of this stuff, then I think you should be fine for now. But yeah, it is becoming an increasing concern for any financial services organization. So I want to bring this back to you then, Arjan. You're obviously a very busy chap. You're running a growing bank, essentially. So I wanted to ask you about, how do you achieve balance in your life, and how do you remain productive in your role?
Balance in my life, that's an interesting one. If you ask my family, they will probably say that I've got very little balance in my life, and I probably need to get some better balance in my life, because this becomes your calling, if you like, your baby. It's constantly, 24/7, and you read the newspaper and it triggers something you need to do, right? You watch television and it triggers something you want to do. Everything seems to trigger something. So at the moment, I don't think I have very good balance in my life. I'm fully aware I need to find that balance, and I've promised the family that I will find that balance in a year or so, because then we're on stabler footing from a bank point of view.
Yeah,
but it's
I suppose it is a very critical time. It's a critical time for you guys right now, isn't it? I suppose so.
Yeah. So there's no balance at the moment, but I'm looking forward to some balance.
But what about productivity then, Arjan? Are you generally more talking in meetings most of the time, or in terms of creating documentation and stuff like that? Do you have any tools or any platforms that you use to remain productive at all?
So I've got a great team, and they some of them use AI now to write certain presentations, as I just said, which it's good.
Absolutely.
I'm very much out there looking for the ways to get our product out there to change the hearts and minds of people and change the heart and minds of our partners, right? Helping them to realize that actually what we're doing is also good for you, and what you've done in the past you can keep doing, but this is growing your business. A lot of my productivity now is to just cement the business model, let people realize what the product does, etc. And I've got a good team underneath to steer the bank, although I still have obviously the committees and the regulatory requirements to do. But in addition, it's the promotion of it, and I have a good team that fills in with everything. Productivity-wise, I think we get a lot done. I think that is important. You read a lot about how productivity is measured, right? It's the output of a country over the number of people, etc. And productivity in the UK is quite low. I think that we definitely have a great output, also because we work so many hours. That's the other thing. So but it's important that you don't burn out either. You need to sleep well, and you need to have a good balance on that side, because otherwise we can't continue forever. We do have a limit, and there are a few times when I actually bumped into that limit. It's a couple of years ago. You just think, I've actually, you fall ill because your body says this is enough. You need a break, right? So I think that's one of the most important things about an entrepreneur is to stop and to take that break, which generally is not one of the skill sets that an entrepreneur has.
Yeah, most of the ones I've met, I'd agree. They are very bad at downtime, for sure. So looking back on your career now then, Arjan, I just wanted to get obviously I know you've got a long way to go, but looking back on your career, knowing what you know now, what advice would you give to your younger self? Let's say your 21-year-old self. What would you say to that guy?
Yeah. So 21, going into finance, etc. You don't know how siloed you are if you go into investment banking. Right? If
Sure.
if I now look at what I've learned after going out of the silo and opening up to all the other things that there are that you need to know about, I think that I would do that sooner, because you learn much more, you broaden your horizon much better instead of doing the silo treadmill kind of thing. So I'd open up more. I'd find jobs that give you more exposure to a wider variety of projects, etc. That's definitely what I would do. Not enough pigeonholing. Broaden the experience earlier in life. Don't wait too long.
Yeah, and obviously gravitate towards the thing that you enjoy most over time. Yeah. No, that's great advice. Yeah. Can I just put a different spin on that question? What advice would you give to somebody at the beginning of setting up a financial services company with aspirations to get a banking license? What have you learned from the last, was it 6 or 7 years?
Yeah.
Looking back now, if you could speak to that guy, what would you say to that guy?
So it always costs more and it always takes longer. Right.
So it's like a building project.
Well, exactly. It's like a building project. It's like a renovation, if you like, which basically means control your outgoings, control your cash flow. Right. And I've been working with some smaller entrepreneurs to do their finances, if you like, and help them a little bit. And they had a normal business, unregulated, and they just need to set up a bank account. And for them, even setting up a bank account is challenging. Getting a bank account is difficult for business nowadays. So helping them with the simple expertise. But it's the same for setting up a bank or any financial services. Make sure that you don't waste any money, that you really bootstrap as long as possible. You get a lot of people say, oh, I can do this for you, I can do that for you. That's fine, but do everything at the right time. Don't do anything too early, because then you just waste capital, and capital is very valuable. So
yeah, sure.
Really, if you think it's like a renovation, it takes longer and it costs more, but do it over a longer time. So you really have to make your capital go far.
Yeah, minimize your chances of making a mistake then. I suppose minimize the likelihood of you making a mistake then.
But you'll make mistakes. The whole point is the impact of a mistake shouldn't be that your other projects suddenly have to stop or anything like that. So you really have to be certain of certain things before you take the next step.
Sure. Yeah, brilliant. Okay, that's great advice, Arjan. Let's finish on this one then. I know you don't get much time to yourself, but is there a book, a story, or even if you don't read much, maybe another piece of content that you've been inspired by recently?
My main inspiration was actually Nelson Mandela going to South Africa. That is the spirit that we should all have more of. Do what's right, not what's right for me. Unfortunately, the country took a wrong turn after that because normal people took over, I think. But that he was unique, and anything that he stood for and stands for, and the way that worked is just an example to me, really. That's been probably the great leader that I can think of and like to follow, really, if I can.
Fantastic. Okay, brilliant. Well, look, yeah, I think we can all agree with that, Arjan. That's a fantastic answer. Thank you so much for coming on. We've covered some amazing ground and some amazing nuggets of wisdom in there. And I just really enjoyed chatting to you. So thank you so much for coming on the Tech Leaders Podcast.
Thank you very much.
Wow, that was a great conversation. I really liked Arjan's fascinating perspective on the evolution of the UK mortgage market against the backdrop of the 2008 financial crisis, which prompted so much change in the city, especially I think across things like lending practices and regulations. Arjan obviously said that Perenna's existence owes much to the lessons learned from this challenging period. I thought that was really interesting. But what really stood out for me was Perenna Bank's unique funding model. Instead of relying on short-term deposits like traditional banks, Perenna sells covered bonds to investors who want steady long-term income, like pension funds and insurance, for example. And this just means they're not tied down by short-term limitations then. It's like blending mortgages with pensions, which has been done in Denmark and other European markets for so many years. So it clearly works, but it just hasn't been done in the UK. But what Perenna are doing has the potential to really shake up the UK market. And with quicker mortgage approvals thrown into the mix, automation and easier access with lower deposits, it could make buying a home a lot easier for more people, especially first-time buyers, which is very exciting and I think could be hugely disruptive in a positive way. But thank you so much for joining us. If you enjoyed this episode, please subscribe, leave us a review, give us a like. It really helps us bring you more amazing guests. Thank you so much for listening. This episode was brought to you by Be Digital. Be Digital support leadership teams to optimize cost and get more out of technology investments. Be Digital and the team have unrivaled expertise with technology license management and data remediation, and are therefore perfectly positioned to help prepare organizations for AI technology capability. And on the last point, Be Digital have just developed a cutting-edge AI readiness assessment, which provides tech leaders with a platform they need to make well-informed decisions about AI adoption strategy in 2024 and beyond. Go to Be Digital UK to find out more and get in touch.